Rob Aspin is our guest host this morning, Chief Investment Officer from MW Capital Management. He joins us from Singapore. We're scratching our heads this morning. You've got 8 new companies on a blacklist. The market is absolutely convinced, seems to be convinced of a marginal breakthrough, and it's batting away this latest salvo. Does that add up for you, Rob?
No, not really. I think it would be actually very surprising if any deal was made at all. I think in the case of Trump, he'll want to push forward and ensure that he gets a very good deal out of it. And I don't think the Chinese are willing to back out. And I think, as you were just saying earlier on, you've now got tech being weaponized, so to speak. And certainly the Chinese are not going to take that lightly. So I do not see a trade deal coming from these discussions.
Well, Rob, let's flesh that out in a bit more detail because, yes, the CSI 300 substantially higher. You've got key sectors like consumer staples, utilities and financials driving that move up. But in terms of some of the other scenarios, maybe it is just a limited deal. Any deal would help sentiment, and that is the question that the Markets Live team is actually asking around that. What would a mini deal do for markets?
Well, I think if you did have a mini deal, even though that's not our base case, it would be positive for the markets in general, particularly the Asian markets, those that are exporting into China, which then exports into the USA. So that would obviously be positive. But I think when you look at the markets and you're looking at the CSI earlier, it's done extremely well year to date. So it's not as if there's a huge amount of upside there. My view is that the market is actually fairly complacent. So if you don't get a deal, there's potential further downside risk. But we'll see how these trade deals or negotiations continue.
Yeah, I mean, look, maybe we should be pouring ourselves half a glass full rather than half a glass empty. I don't know, greater minds than I. But in terms of how you protect yourself, I thought there was a great piece this morning. JP Morgan, they talk about dollar yen. We talk about gold, we talk about Swiss. But on dollar yen, they're saying it's the only cheap recessionary hedge left out there. Why? Because they say it's 15% cheaper than the average over the last 20 years, and it's more appealing for them. Would yen be a more appealing haven relative to Swiss, relative to gold, relative to treasuries, given that kind of math?
Yeah, it's a very good question. Our view is that we're still dollar bulls at this point in time, but if we do see the manufacturing data declining further and economic growth declining further, and the risk of a recession increasing, we would then start to shift into the yen at that point in time. So we think the trade is a little bit too early at this point, but we are looking now at the yen as perhaps a safe haven currency. But this is not to say that we wouldn't hold yen plus some of the precious metals. We do like silver, which right now is trading at a very attractive range against gold. So we would actually be going into silver at this point in time, holding US dollar with the view of moving into the yen should we see weakness.
I mean, you talk about using the yen as a hedge. We went through your research, and what really crystallizes from that is that you're keeping a close eye on a lot of important geopolitical developments around the world. Not just what's happening in Hong Kong, but also what's happening in places like Turkey overnight. Quite a bit of movement on that story. Is it time then to add gold to that portfolio as well?
Yeah, we would actually be focusing more on a balanced portfolio at this point in time. So we're actually talking to our clients about doing that, shifting a little bit out of equities, moving more into balance, which would be a mixture of equities, fixed income, and gold and precious metals such as silver. Relative between the two, we prefer silver at this point in time. Turkey is an interesting question, though. Turkey has around $450 billion worth of US dollar denominated bonds. So when Trump talks about obliterating the Turkish economy, he can do that in terms of exports and so forth, but that will then have ramifications on those bonds and hence the banking system as well. So there's a lot of interlinks here that one needs to focus on.
Rob, you're staying with us. We still have a lot to get through. That's Rob Aspin. Rob, let's jump straight into the Bloomberg, get that additional context around what the market expectations are around potential Fed cuts going forward. At the end of the month, for the third time, quite a bit of doubt then for those rate cut expectations around July. What do you see the bank doing given the lacking punch that these policies clearly bring now?
Well, we do expect that rates will be cut a little bit further, but the commentary is correct in the sense that the central banks are starting to lose ammunition. They don't have the ammunition left really to stimulate the economy further. And if you look at Europe, for example, where you have negative rates, look at the prices of Deutsche Bank, for example, Commerzbank. These are very large institutions, and they're extremely weak because the spreads are very narrow due to, in part, negative yields. So it's a very difficult environment for the banks in Europe, and the US will obviously be looking at that and questioning whether or not or how far rates can go before it starts to impact the financial sector. What we think will occur, what needs to occur to some extent, is that fiscal spend will increase, and that will obviously have to be driven by the public sector.
We're going to get the start of the third quarter earnings season. We reckon that we're going to see a drop in outright earnings. I want your opinion on this. Peter Oppenheimer at Goldman Sachs, along with a number of other institutions, are still sort of saying, look, it's too early to opt out of the equity bull run. You want quality and growth stocks. They're going to continue to support the position. You're going to have free cash flow, yield, dividend yield, buybacks, all there. I mean, these sentiments, would you echo what Peter is saying here? Too early to pull a ripcord?
Yeah, I'd actually agree with that to some extent, and we manage accordingly. If you look at Fed action, that will typically feed, so through lowering rates, that will typically feed into financial assets, as we've seen in the last few years. So it's very potentially likely, shall we say, that the lower rates will feed into the financial sector, which will support equity prices going forward. And to be honest, when you do the stock picking, which we do, we can find some very attractively high growth names. So we have a barbell approach, cheap high growth, and then on the flip side of that, we have good companies with stable cash flows and high dividends. So you're capturing a little bit of growth, you're capturing a little bit of dividend yield as well.
I mean, Rob, that all sounds great on the face of it. The folks at Bloomberg Intelligence make clear that the sell-side equity analysts' 7.7% estimated earnings growth for the coming 12 months is way more bullish than the Bloomberg Intelligence macroeconomic model suggests that it should be. Why don't you share some specific names that you're excited about that actually fit that bill?
Sure, I won't mention names in particular, but if you look, for example, at the Chinese internet sector, particularly focused on online retailing, we can find some excellent names there that are trading anything from around 10 to 15 times earnings, and the growth rate is in excess of 20%. So you're buying a company which has phenomenal growth potential over the next year to 5 years at least as the online penetration increases in China, and is giving you attractive valuations and very, very strong earnings growth and cash flows. Likewise, we've found a company in Argentina that does online booking, for example. Argentina, LATAM is obviously going through its difficulties at this point in time, but you're buying a company which is the largest part of the market, around 25% share of online booking in LATAM, and only has a market value of around 750 million with an EV of about 450. So there is value there, but you have to look globally and you have to find the stock picks.
Okay, it's all about discerning optionality. Rob Asman, Chief Investment Officer over at MW Capital. Thank you for your